Welcome to the Investor Coaching Show, a podcast to help you get an insider's view of the financial world and escape common investment traps. And here's your host, Paul Winkler.
And welcome. This is the Investor Coaching Show. Paul Winkler, Mr. Ira Work, Mr. Evan Barner. And going from the new studio setup here. This is fun, guys.
This is high-end,
Welcome
man.
to the...
This is great.
You know, it was a long time... You know, the carpeting in here needed to go. and Ira,
And Ira needed to go.
That is a cough button. So if you have to cough, look at that. See,
I figured that was a cough button.
All right, so you tell you this is pro.
So everything is like set up there.
Oh, it
like
is.
It is here in house.
Yes, it really is.
Yeah.
Except it's clean and new here.
Oh,
You did not.
see, that was a
did
better wolf
not
howl
go there.
than you did.
You did not go there.
Yeah, well, I don't think that you should let Michael and Dan come and see this place because they might want to work out of here.
They'll remote out of the office. Yeah.
Exactly.
We'll be the entire station comes to the office here. Well, it's not that nice, but yeah, it is.
No, it is. It sure is.
Yeah, it is. It is.
Well, I like it because it's spacious. We've got lots of room in here, and we can spread out, and we have all our technology, and this is really good. So exciting! It was a lot of work. We got this all done here.
Great job, Stuart.
Yeah. Stuart, Paul, Michael, Scott, and we were all kind of going nuts in here yesterday. All right, so there are so many different things to talk about that have nothing to do with this studio, and I'm just trying to decide where to start regarding all of the news, the financial news. There was a question that came in. Maybe I'll just start there because it happens to be at the top of my stack. A question about investing in international markets and emerging markets exposure, and just when you invest, okay, so that you have different markets, you have U.S. markets, you have international markets, established international markets.
Right.
And why do we invest in U.S. markets? Well, obviously, because we live here, number one, but you have a very strong service economy in the United States. So we're very much service-oriented. And typically, what happens as you evolve as an economy, typically what you do is you move from... And there's this big debate about manufacturing and how important it is to make sure that we have some of the manufacturing done here in the United States. And there's no question that there are things that need to be done here in the United States, simply because there is as far as foreign exposure or having foreign control over manufacturing might be a risk from a national security standpoint. So, really, we've got to actually watch out for those types of things. But in general, I'm just speaking in general, what happens is that you typically move from a manufacturing standpoint to a service as you become more evolved, just simply because the technology is more complex with a service versus a manufacturing type of an economy. So, in essence, that's what has been happening. As of, the past 20, 30 years, we've had that. Now, the interesting thing is what most people don't realize is we do every bit as much manufacturing in the United States as we ever did. We just do it with fewer people. And the reason is because we have greater technology that allows the manufacturing to be more efficient. And a lot of people don't realize that, but that is the way it happens. So, in essence, what we have, though, is more of that service type of focus. Now, if we want manufacturing in our portfolio, which we should want that,
right,
typically you're going to have a little bit more value in that particular area of the market, value being companies that are going to be a little bit more distressed because manufacturing is on the lower end of the totem pole. What ends up happening is that you have greater expected return from the value end of the portfolio. And to get that type of exposure, we have to go to international markets. So if you look at U.S. markets for small cap stocks and you look at international markets for small cap stocks, I'm just talking about blend. I'm not even talking about the value end of the spectrum. You will see that the rate of return for small cap U.S. stocks going back the last 30, 40 years, 50 years even, you'll see that there's a couple percentage points higher return in small company international on the blend side than there is for U.S., and it's because it's just a little bit more value-oriented, and that's really what's going on. So if you look at it, you look at the prices are going to be lower compared to earnings. You're going to look at the prices going to be lower compared to book values. Now, if we look at international markets in general, is that, well, that's one of the reasons that we want to do that is we have more of a manufacturing focus. The other reason is because, hey, you don't know what's going to happen with American politics. I mean, can we just say amen to that?
Amen.
And because of that, you can have the dollar either strengthen or weaken, resulting of what happens. Now, recently, dollar's been strengthening. If you go back 10 years, it was weakening back at that point in time, and international markets do better on a weakening dollar because it takes more dollars to buy international stuff, whether it be goods or whether it be stocks in those companies in countries that are outside the U.S. Now, the other thing that you have is emerging markets. Now, that's the third area. Now, you have established markets, Germany, France, Great Britain,
Japan,
Australia, Japan,
Korea.
right? So you have those. Now, with those types of companies, you have a more established market. You have better property rights protections, those types of things. Emerging markets, you go, well, that's kind of a speculative area. So what we do is we say, hey, we're not going to have as much in emerging markets, or we shouldn't. And I've seen people come in here. I think it was a Fidelity. Yeah, it was. I know it was. I can say it out loud. It was a Fidelity fund that was a target fund, and they loaded up on emerging markets not too long ago.
Yeah, I'm
that,
thinking
Evan?
I saw one that was like 10 or 11%. I mean, it was a pretty big number.
It was pretty high, and it was
unreal.
Of their top 4 holdings, it was like 2 of their top 4 holdings in the entire of a 22 fund portfolio.
Yeah.
It was 2 of their top, out of the top 4, it was 2 of them. So with emerging markets, the one thing you run into, though, is property rights protections. And then you have market makers. How many people are security specialists? In other words, you have to have somebody that makes a market for the security, and typically you want to have at least 4 market makers. And those market makers are going to be the ones that hold the securities in the portfolio, and they're going to be trading, and you're going to be competing against each other. So that's the idea. It's having somebody that having a level of competition so that the pricing is proper. And that's the reason. That's the reason you do this. Okay, so emerging markets, you have to have that. Another thing is, how many different countries do you have? How many different countries do you have exposure to? And the number of countries that you have exposure to should be fairly broad because you have a lot of different countries that are emerging markets countries. Now, the other thing that you have to think about is in terms of how even it is between these countries. Now, this is where it can get a little bit interesting with emerging markets, because the biggest, by far, country in emerging markets is going to be China. Yep. And it's one of those things that you go, ooh. Now, we looked at, if I look at a portfolio, what you will notice is that even if you do things as broadly diversified as you possibly can be, you'll notice that emerging markets should be, or China exposure should be no more than like 1.3, 1.5%. Actually, I looked at my exposure in my own personal portfolio, about 1.3%. So it's not a big deal, not a lot. And the reason that you have any exposure is because, hey, you know what? The United States used to be an emerging market. We used to be one of those emerging countries that nobody really knew, are they going to make it?
We were country when country wasn't cool.
Yeah, that's exactly right. And, if you look at other fund, and one of the things that I have to do is when we're looking around at portfolios and looking at designing portfolios, you have to look at how much or what different fund companies, how they get exposed to these countries. And, if I had my druthers, I'd probably say, I'm not so crazy about being exposed to China. But the reality of it is, I can't design a mutual fund. I can't put together a mutual fund. And if you look around, you'll see that it is pretty standard. Like Vanguard has literally 32% of their portfolio is exposed to China. for their emerging markets portfolio. Fidelity is 24%, BlackRock 32%, Goldman Sachs 26%, John Hancock over 26%. And, so the reality of it is not having some exposure to China in an emerging markets portfolio isn't a realistic thing. Because you don't have any of the major fund companies that actually don't have, and they're all about the same when it really gets down to it. Number one. Number two, another thing to remember is this. So if you look at an emerging markets portfolio and you get alarmed to see how much exposure you have to China, remember not too long ago, we had Greece.
Right.
Remember Greece? That was that country that had
Get out now!
a really bad debt crisis, right? And, it was interesting because back then, I was doing TV and I was talking about the debt crisis and I was doing a TV show on the debt crisis. And, people ask me, do we have exposure to Greece? And you don't want to be that person that goes and just sells out just because people are worried about something bad happening in the country or that they have politics that you disagree with or whatever. Because it wasn't that long ago. You guys remember this. Mm-hmm. It wasn't that long ago that Greece was the number one country in terms of return in all countries all around the world.
Yeah, it was like 53% or something.
It's 44%.
Yeah.
Yeah, it's 44%. But it was, and that was the top country as far as return goes. Now, that was after the debt crisis. So if you imagine you're that person that goes, let's get out. And then all of a sudden, it's the top country in the entire world. And here's why. Because remember, when you're investing, don't ever forget this. You may look around and go, things look awful. Oh, things look terrible in this country. Oh, they look bad in this country. They look bad, And what you don't necessarily recognize is that there's still a cost to using your capital.
Right.
They have to still pay to use your money. And they might actually have to pay more to use your money if there are problems. And I dare you to go. I'm not a big fan of China either. I'm just here to say. But I dare you to go out there and just go put these two words in a search engine and see what you come up with. China unrest.
Yeah. That's probably a pretty wide range of topics.
It is
actually.
a lot of it. Yeah. So, and the reality of it is, if you do this right and you have an emerging markets portfolio, there's no way to avoid a little bit of exposure to that because all the fund companies have it to some extent because they're using ADRs and which are American Depository Receipts. So you actually have those things traded in the U.S. There are some pretty good property rights protections. But this is why you don't put all your money or you weight it too heavily in any one country is because those property rights protections can dry up in any emerging markets country, in any one of them. And that's why you always limit your exposure to emerging markets is because of that. They have historically, if we look at history over the past 20 years, you look at emerging, you'll see there's a higher expected return for that segment of the market. But with that higher expected return comes more risk. You guys didn't chime in. Come on.
Well,
Stuart chimed in. Come on, guy.
I was raising my hand for a
okay,
comment.
you were raising your hand. That's
What?
true. You were. Okay.
No, as you were talking about just the category in general, and talking about emerging markets small, that kind of came up in the conversation.
Yes, sure.
And that has always been an example that I've used with clients and new people is talking about the philosophy that we use of being so broadly diversified. Mm-hmm. If there was an area out there where you would at least think intuitively, okay, stock picking's really got an edge here.
Yeah, good point.
It'd be, the small company, the new shoe manufacturer in Brazil. You would think
should be able to find a mispricing in that market. Yeah.
In an emerging market.
Yeah.
And when you look at a fund that's properly diversified, that performance trounces the benchmark. It trounces the average funds in those categories that are all doing stock picking. And it goes to show that markets are efficient everywhere, whether you think they're efficient or not. They are.
Yeah, so true. So what Evan's saying, so typically what you often hear is that, you use an index fund because indexes have higher returns historically than actively managed, where they're trying to pick stocks and time the market. And you think, good grief, we ought to be able to pick stocks and time the market in emerging markets. Nobody's paying any attention. So there ought to be mispricings everywhere. And indeed, you do see that the index, though, has a higher return. The indexes historically have had higher returns than active management. But if you look at when you actually properly diversify it and you don't overweight large companies like index funds tend to do, and you don't overweight less value-oriented companies, that when you do this right, without stock picking and market timing, by the way, that the returns historically have been higher in those areas as well, as a result of putting a little engineering in place when you design a portfolio instead of just going, right, yeah, let's just throw this thing together based on the weighting.
Free markets work whether you believe in them or not.
That's right. There's air in this room, whether we believe there's air or not.
Yeah, exactly.
I think the thing that goes often overlooked, though, is the fact that as American investors, we tend to believe we are very, very focused and knowledgeable about what's going on with the companies here in America.
Sure.
But I think we look at what's happening outside is that they don't know what's going on. But if you take a company like Australia,
that's a height of ego, isn't it?
okay, if you take a company like Australia, I am sure the Australians are much more in tune about the companies in Australia.
In their country.
And the people in Indonesia with their stock market, they're more in tune about what's going on in the companies in Indonesia than we are here. So for us to think about an American mutual fund manager has an edge to picking stocks in Indonesia or Nigeria is just ludicrous.
Well, it's interesting you say it, Ira, because you look back to the wisdom of crowds. And they had that thing where they go and guess the dress weighted of the oxen. And the funny thing about that story is not that there were just informed people trying to guess the weight of this thing. So the story goes as this, that they were guessing it. A statistician comes in and says, let's buy all of the guesses and see how close everybody is collectively. Let's take all the guesses, add them up, divided by the number of guessers, and see how close they come to what the weight of this thing ends up being at the county fair. And they've come within like a couple of pounds of it. I mean, it's literally, but nobody got it right. But collectively, people were dead on. But here's the interesting thing of that study, is that many of the guessers, probably most of the guessers, were uninformed people. But they had a little piece of information that maybe somebody even that was informed didn't have. And nobody had all the information, but collectively as a group, they had the information. And hence, even the market for guessing the dress weight of the oxen is efficient as well. That's the funny thing about it, is trying to be smarter than everybody collectively just doesn't happen. So even people that aren't as well informed outside of the country seem to have it going on. But certainly you have people inside the country would definitely have a greater knowledge of it, no question.